Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, audience. Welcome to Achieve Wealth Podcast, a podcast where we are tuning in to learn as much as possible. Today we are bringing in an awesome guest who is keynote speaker in many conferences, many high-level conferences. So was able to get his time to spend with us today to go through as what I call the State of the Union of multifamily real estate. So today we have Jeff Adler, who's a vice president of Yardi Matrix. Yardi Metrics is a U.S. multifamily office industrial self-storage asset information toolset in originating, underwriting, and asset managing commercial real estate investment. So if you have subscribed to Yardi Metrics report, which is awesome, very, very data rich, and I think it should be part of your decision making in selecting markets and looking at trends in terms of commercial real estate, especially on multifamily. Your mail would have come from Jeff Adler. So I'm very pleased to bring Jeff on board. So Jeff, why not you tell my audience about something about yourself and your company that I would have missed out?
Sure. So I'm based here in Denver. Yardi Matrix is basically the data division of Yardi Systems, which is well known in the property management sphere across all different asset classes. We cover multifamily, office, industrial, self-storage, in all those different other asset classes. My background was primarily in multifamily. I was the chief operating officer of Aimco based in Denver for about 10 years, from let's say 2000 to 2002, 2009. And I joined Matrix about 5 years ago. So that's kind of what we do. And some of the work that I do is, the basic product's a toolkit that helps you identify opportunities, find deals, underwrite deals, understand markets, understand entities and players in those markets. And then on top of that work, I have a team along with Jack Kern that talks about investment strategy, investment themes, the overall economy. And so we try to put everything into context, from kind of what's going on in the global economy straight down to, which deal should you buy that fits your investment strategy. And that's kind of what we do. So happy to be on the podcast and give you any information about, what it is we're thinking.
Yeah. I'm very excited because I read the reports that created by Yardi Metrics on whenever you guys send by market, by economic at high level. So it's very, very informative and I love it.
Yeah. And so one thing I kind of forgot is as a part of what we do to get our name out, you can go to yardimatrix.com/publications and for free sign up for our metro reports, where we do those 10 multifamily markets a month, 6 office markets a month. We also do a monthly report that's free on the multifamily market nationally, the office market nationally, and the self-storage market nationally. So, there's a lot that you can plug into that kind of can set a context that we provide free. And then if you want to learn deeper, then you can, talk with us and go deeper into the data service. But so those are resources that are available to all of your sort of listeners.
Yeah. I would encourage all your listeners, if you want to do commercial real estate, especially multifamily or even office or self-storage, go and subscribe right now. It's an awesome tool and information is free and it's really good. Right. So okay, let's go.
What else can I do for you? What else can we? Let's get in there and let's start talking.
Yeah, correct. So, this podcast, I know we talk a lot about multifamily because I'm a multifamily operator. We own like 1,400 units in San Antonio, Austin, Texas. But I want to always understand about other asset class. Recently I launched a book. It's called Passive Investing in Commercial Real Estate, which I talk also talk about other asset classes. So I'm very happy to ask you questions about other than multifamily, as a start. So compared to multifamily, office, and self-storage, what are the good and bad about each one of these asset class from your perspective, since you look at all of this?
Yeah. So I think personally, I think multifamily is in an incredible sweet spot. Okay, so let me first give you a take on multifamily, and we can compare it to other asset classes.
Okay.
The reason is that there is an overall shortage of housing in the United States. It's to a greater or lesser degree in different markets, and then it's really kind of an overhang from kind of the crash in 08, 09. So we had a surplus of housing in going into the crash, but really now we have a deficit. On a cumulative basis since 06, we've got a 200,000 unit, both multifamily and single family deficit. If you go from the bottom of the crash, it's about 2 million units. So how this is being expressed, right? And we also have a number of demographic trends. People getting married later, having kids later, having fewer children, having student debt. So if you look at all of the divorce rate, if you look at all of these demographics, we seem to have like a secular shift, right, in the number of renters and the renter household population in the United States overall. And you see that expressed, okay, in very high occupancy rates since the crash that are still hanging in the 95, 96 level at the national level, which is very, very high. And rent growth that historically, if you look at, and I've done this back to 1970, okay, CPI and rent growth were very, very tightly correlated. Since the crash, right, the rent growth has been about, cumulatively 500 to 600 basis points higher than CPI. It is an anomaly. So it's not like the normal cycles you can go back to. This is fundamentally different. Okay. Now and you can look at it to the extent that there is new supply coming on, about 300,000 units a year. It's Class A, kind of urban core, or in places that are sort of urbanizing nodes. The big opportunity for small, I'll call it non-institutional investors, has been in Class B and Class C. I'll call it 50 unit to 100 unit, where there's not a lot of institutional competition. There is a deep need for housing, and the price umbrella of the new supply is so big. I mean, the new stuff that's coming in is $500 to $600 a month different than kind of the sort of majority of the workers and renters can afford and are paying. So you're really insulated from new supply pressure. And so again, if you look at the demographics in terms of the demand, and job formation is really pretty good. Okay, so and then you look at the fundamentals of supply. It's very expensive to bring new supply to market. There's a labor shortage. Material costs are going up. Impact and zoning fees are high. So you have kind of the recipe for a great demand supply balance in multifamily. And the severe problems happening on the coast. So just talking to your maybe constituency in Texas, right? If you look at the severe the problems that are occurring in California with job growth and affordability, there is a significant outmigration from New York, New Jersey, Illinois, and California, and moving into all of the markets in North Carolina, in Texas, in Arizona, in Nevada. And so you have, in addition to the tailwind of organic economic growth happening throughout Texas, you have relocation, right, in a relatively business-friendly environment with a very high level of supply response relative to other parts of the country. So, you have a lot of very positive things. So I'm very, very positive on multifamily as a sector, particularly Class B and C assets. C is a little tougher because only just until recently, you began seeing finally wage growth at the bottom end of the skill sector, people who traditionally go into a C-class asset. B-class asset in my mind, is a little bit better because there's more income growth there, and there's more to sort of to work with. C-class assets, generally speaking, you make your money on having very low expenses, by having very low turnover, by picking your customers very, very carefully, so that you get a community that's going to stay there and can tolerate maybe 2% rent increases, but you really can't push rents 5, 6, 7% in that group. They just don't have the income. Where in Class B, you can push rents higher, accept a higher level of turnover, because there's a deeper pool of people who can kind of pay the rents. So it's really, but those strategies, particularly for a non-institutional investor, are very attractive. So very, very attractive. I really find those, there's a deep market. There's a deep market in terms of demand. And I view the economy as in pretty good shape. There are some pressures. We're late into the cycle here. So the biggest issue I see short term is the potential inversion of the yield curve. Long-term rates are like, 2.7-ish. They were at 3.2, and now they're at 2.7 again. Short-term rates are at 2.25. So there's not a lot of room between the 10-year and the overnight rate. Okay. And what the importance of that is that if the short-term rates go higher, bank lending will pull back, and the data has been historically you're 12 to 18 months from a recession. We're not there yet, but it's a tightrope. Okay, my best guesstimate right now is we probably have another, I think 2021-ish is when it's likely to have a recession. I don't think it's going to be a big one. I think it's going to be kind of a mild one. And the reason I think that is we did a big blowout in 2009. And if you go back historically, and I'm bouncing around on you a little bit, but if you go back historically, the best analogy is what happened in the 1930s, okay, versus post-World War II recessions. They're different animals. So I think, we're coming off of a big blowout, really a depression we got through very quickly because of great action on the part of the Federal Reserve. So I do see a recession coming up, but I do think it's going to be a mild one. So really, multifamily is best positioned, in my view, to sort of ride through this recession. And so, I think multifamily is a great asset class. It's garnered a tremendous amount of institutional investment capital, and will continue to. There is there are other asset classes out there. So office has traditionally been, I would say, a big kind of institutional asset class, requires tremendous amounts of capital, and is really viewed as a bond alternative. Okay. And if you think of that as a bond alternative, it's bought largely for cash. If it yields 4 or 5%, that's great. Again, they're viewing it relative to bonds, right? And it requires a tremendous amount of capital to keep those assets fresh. And so it's unless you're if you're an opportunistic office investor, you really have to take something like suburban office, which is really beat up to hell. Okay. And change its fundamental character, connect it to transit, make it into a campus, create a place. Now that has tended to require a tremendous amount of capital, right? So in order to play there. So I kind of view office as just really more of an institutional capital play because of all the capital requirements that are required for it. And it's hard for a non-institutional player, in my view, to have success in office unless you are riding off the coattails of a smaller building attached to these other investments. It's just very hard thing to make work. Now, the big play in industrial, and I'll shift over to storage in a second, is really kind of what's going on with e-commerce. I mean, that's what's driving industrial is the e-commerce need and then really the pullback in retail. So retail is littered with strip malls that we just don't need or can be repurposed to other uses. So what I do see often is people who are opportunistically looking for sort of beat up retail assets and are distressed and changing the nature of that asset. But for industrial, what's driving the market is not so much manufacturing, which really, isn't driving space requirements, but it's really e-commerce. And those tend to be very large facilities. I mean, like 500,000 square feet, 1 million square feet, that are in near population centers to handle the demand. So there's active development pipelines in industrial. Again, it's very hard, I think, for a non-institutional player to sort of access the action because of the capital requirements that are needed in industrial. Self-storage is very much a different play. It is historically owned mostly by small owners and non-institutional players. The capital requirements to get into the sector are, generally speaking, much lower than multifamily or any of the asset classes. Right now, the issue at the moment is that there's been a significant level of development. Self-storage as a sector did incredibly well during the downturn. And the reason it did was that most of the people who have stuff, and only about 10, 11% of the population use storage, okay? But most of the people who did use it, they needed it, to store their extra stuff. They didn't, in a downturn, they didn't stop using it. In fact, in some cases, people used more of it because if they were going through struggles in their homes, right, with downsizing their homes or apartments, they moved their stuff into a self-storage facility. So the sector did incredibly well in the recession, has attracted a fair amount of capital, and now more and more institutional capital is trying to get in. There's been a lot of development that's been going on. And so the big issue in self-storage is finding an asset that's not under supply pressure or finding pockets. And self-storage is a very local kind of asset class. The bottom line is the world is within 3 to 5 miles. That's it. Like somebody could do something across town and it just doesn't matter, right? It's really that 3 mile pocket. Our view is as a 10 to 15 minute drive time because people are using storage only to the extent that it's near them. Okay. So a lot of storage developers basically track new developments in multifamily and will plop a deal down close by, or they'll look for new home construction and plop something near there. Look for pockets where there is less than about 7 square feet per person, and that's the tools we provide, where you can actually find the pockets of population that are not currently served. It's a good asset class for a non-institutional investor to get in, and it does complement very nicely with multifamily because they're complementary kind of asset classes. I would say that you didn't ask for it, and then we don't necessarily cover single-family rentals per se, but I would say again, single-family rentals along with 50 to 150 unit multifamily and self-storage, they're all complements of each other. They're around people who need space to live but don't have the capital, right, to actually get into buying a home. And so I find we kind of track, we cover self-storage, we cover multifamily, and we track single-family rentals because I view it as a complementary asset class. I know a lot of people in that sector. I actually was in that sector myself for a year, and I just view that entire space as very good for kind of the smaller institutional player and the non-institutional investor. So I mean, was that a long exposition? But
no.
I wanted to lay that out in terms of my thinking.
Yeah, I didn't know that you guys have some tools to look at the self-storage demand analysis, which is very interesting.
Yeah.
Okay. So, wow, that's a really good explanation. So coming back to multifamily, right? So what you're saying, from what I heard from you, is the 2008 crash, the whole crash is equivalent to 1930s crash. And that's a huge crash, and we don't expect to see that in the next coming crash, right? Because a lot of people have that short-term memory about 2008, and everybody's like, okay, I'm not buying it. It's going to go down like what 2008 happened. Is that correct?
Yeah, I think that the 2008 was an 80-year event.
Okay.
We're not going to see something of that magnitude in our lifetimes. What we're likely to see on a go-forward basis is something akin to the recessions that occurred prior to 2008, right? The 2001 recession, the 91 recession, even further back. Right? So these were typical kind of recessions that were not driven by debt blowouts. But what connotes a depression event is that they are fueled by over leverage in assets classes, right? A typical recession is where there's inflationary pressures in goods and services, which then is kind of cooled by rising interest rates and a kind of a minor deleveraging, right? So if you want to kind of get deep into this for anyone who's on this, Ray Dalio, D-A-L-I-O, who's the CEO of Bridgewater Associates, has a great video on YouTube on a 30-minute video on how the economic system works. And he pretty much lays out basically the notion of minor debt cycles, which occur every 7 to 10 years, and a major debt cycle, which occur every 75 to 100 years. We just went through a major kind of blowout. So we're unlikely to see a major blowout again in our lifetimes. We'll now do, I'll call it normal minor recessions. Okay. And so, you got to be forward looking as opposed to sort of backward looking, Okay. So with that in mind, right, the debt position of households and businesses are actually in pretty good shape. The issue we have is that the debt position of the federal government is the thing that's a concern. Now, fortunately, and again, I'm taking a bit of a tangent, sorry there, is our debt is denominated in our currency, okay? Correct. So the debt really isn't going to be a problem because it can get inflated away. So other countries don't have that luxury. And if you're worried about potential inflation, well, you want to be in real estate because it basically marks to market on inflation. And our debt is denominated in fixed dollars. So, paradoxically, in a weird kind of way, real estate is very attractive because its yield relative to current interest rates is high. But even if, for God forbid, we had an inflationary cycle that came back, if your debt is denominated in fixed dollars, you make money because your debt depreciates. Correct. And your income goes up nominally because your rents are set in nominal dollars. Correct. So I'd say, real estate is kind of is a win-win. Like if there's no inflation, it's good. If there's lots of inflation, it's still good. What I would do is make sure your debt is fixed, is fixed, versus, I wouldn't go with a floater right now in terms of floating rate interest rates. That wouldn't be a good idea.
What about floating rate with a hedge? I mean, there's a cap on the floating rate. I mean, a lot of people do bridge loans or short-term loans, but they do a hedge.
Well, so again, I'd say if a bridge loan is designed because you have a value enhancing program that you're going to execute. Usually it's a 1 to 2 year bridge loan. And for that purpose, it's just fine, right? Because you're going to do something different. You're going to create value. You're going to add capital. You're going to reposition the property. So that makes perfect sense. And you want something that gives you your payments as low as possible while you're executing your value add, right? When you're done with that value add repositioning, if you choose to hold the asset, that's when you have to think about permanent financing. And you don't want to be, kind of on a floating rate, IO forever in that case, because you're not getting the advantage of what might happen in the broader economy. Okay. You're maximizing current return, but you have an exposure. Okay. So I kind of view bridge loans as appropriate in the context of a value creating program. But outside of it, it's very dangerous. You got a lot of risk you're taking on.
So do you think someone should be, I'm out of all my short-term loans. So now I'm on all long-term fixed rate loan, all agency loan, which is good. But I know a lot of my listeners, I have this notion of, hey, let's go and do bridge loan. I mean, it's easy to make deals work under a bridge because you get higher leverage. But there's also a notion of now we're going to, hedge the bets on the interest rate hike by having an edge, and there's a cap that they can do. So
right. But I would say here, but if the cap came into play, let's say the cap comes into play, it's a cap per year. I guess suppose there is a lifetime cap, but it's at a very high level. If you had to get out of a bridge loan, what you have to get into is going to be very unpalatable at the time.
Okay.
So I do think, again, if I was giving advice to an investor, is to say a bridge loan is great for a specific objective you're trying to accomplish, but it is not a long-term hold strategy. If you're doing it, just understand you're going to maximize current income, but you are taking on an asset risk that's rather significant. And look, everyone will make their own decision, and if they choose to do that, then they choose to do that. But you should be aware of the risk that you're taking, and not kid yourself about it.
Yeah. Especially on a syndication world, right, where we are raising money from private investors, and we just have to make sure we communicate that to the investors, and everybody's okay with that, right? So interesting. So you're talking about yield curve inversion, right, where the daily yield curve might be higher than the 10-year treasury, right, at high level, right? So what is causing that?
Well, what you have is an interesting kind of situation here, okay? And this is more geopolitical than anything, but it has deep implications for us in real estate if you're trying to understand the demand side, okay? So this is the issue of, again, demand looks great. The economy is expanding. Jobs are being formed. Unemployment's low. Wages are rising. This all sounds, Jim, it sounds great, okay? So what happens in these periods of time? Well, normally, right, you would begin to see inflation, right? That would kind of rear its head, and the Federal Reserve, executing its mandate to try to kind of make sure inflation doesn't get out of line, would tend to be pushing up rates on a short-term basis to quote unquote cool the economy, right? But what we're seeing very interestingly is we're having economic growth, but where's the inflation? Okay, you're not seeing inflation really be systemic above a 2% rate, okay, which is what their stated goal for price stability is. And why is that, right? Because growth isn't that great in Europe, growth isn't that great in Japan, and the trade pressures that the administration is putting on China is basically hurting the Chinese economy, which is why they're at the table in the first place. And so there isn't the systemic long-term inflationary pressures. So as a result, long-term rates, which are set in the market, the Federal Reserve has no influence really on long-term rates. They affect short-term rates. They can set short-term rates, but long-term rates, they can't set directly. They can try to influence it, okay? And they did try to influence it in the past by buying up mortgages and other long-term securities. But there's a lot of, we're generationally, and this is some folks get it, some folks don't quite realize it, we're in a demographic period of time where there's a lot of global savings, okay? And if you look at those global savings, they are going into bonds. And if you look at Europe or Japan, because their economies actually have declining populations, they're in a saving mode significantly. They're not in the consumption mode, they're in a saving mode. They've got a lot of capital to deploy. Interest rates in Germany, okay, for 10-year German government bond are negative. Negative. So our 10-year notes at 2.7 are the equivalent of what Italy is paying. So if you're a European investor, do you want to put your money into Italy or the United States? Because that's really the choice, right? So if I had a choice between Italy and the United States, I'm putting money into the United States. And so we are attracting a lot of capital on a long-term basis, which is keeping our 10-year rate pretty low. And there's no real evidence of inflation, right, to justify investors saying, oh my goodness, I need to be compensated, right, for inflation. And so I should get out of bonds because I need into other assets that would cause the long-term rates to rise. So if long-term rates aren't rising that much, and there's not a lot of inflation, the Fed pushed up short-term rates to the point where the fourth quarter, right, when the stock market melted down, was really a function of the market saying, well, if the Fed keeps raising short-term rates, they will create a yield curve inversion. And what happens is that short-term rates are higher than long-term rates. Mm-hmm. Well, if you're a bank, banks are in the business of lending money, borrowing money on a short-term basis, and lending money on a long-term basis. Well, if there's not enough margin in there for them to do that, they have costs. They stop lending, and again, because they would lose money if they borrowed short and lent long. It's not profitable, so they choose not to lend money. Well, what you're talking about there is a contraction of credit in the economy. Well, when credit contracts, guess what? Though it takes a little bit of time, you get a recession. You don't get a recession tomorrow, but within 12 to 18 months, you get a recession because there's a contraction of credit, and that works its way through the system. So if you think about us as in real estate, we deal in metrics that are rents, occupancies, and things like that, our cash flows. Those are lagging indicators to what's happening in the real economy. What's happening in the real economy is wage growth, right? Employment, right? Those are the things, inflation, those are things that happen in the real economy. I look at the capital markets as a precursor to what's going to happen in the real economy, which is then a precursor to what's going to happen with real estate operating metrics. So by paying attention to the capital markets, I try to keep our clients and our organization, 2 years ahead of what will eventually show up in rents and occupancies and cash flows in real estate properties. So that's why I think why I kind of dwell on the yield curve, because if I look at, there's 5 models that we look at in terms of capacity utilization, wage pressure, and of the 5, the one that is I'll call it the current binding constraint is the yield curve. So it's not the only thing I look at, but it is right now the key thing that I look at.
Yeah, so that's the best explanation on yield curve and how it's going to impact. Because I read wrote so many reports and listened to so many webinars by brokers and all that, but that's the best explanation. I get it completely. So what you're saying is, if there's a yield curve, banks start lending. Bridge loan is more dangerous, because if you are predicting that's going to happen by 2020 or 2021, and if you are initiating a bridge loan right now, which has a 3-year span, you're going to be lending in a spot where you may not have any funding at that time, right? If the banks stop lending.
Right, and also you don't want your maturities to come up in a crash, right? Mm-hmm. Because what's going to happen what happens in a downturn, even if it's a minor recession, is people withdraw from the market in terms of transacting. They don't transact. So what transactions do occur tend to be at a depressed level. That depressed level then is considered, quote unquote, the current market value. If you have a bank loan or a line of credit that's coming due, they're going to revalue your loan to value based upon an artificially depressed valuation. And then they're going to say, oops, your loan to value is a mess. You got to come up with it. So basically they're going to squeeze you out. They're going to force you to add in more equity, right? Or to basically liquidate the line. So you do not want to be in a situation where your debt, if you have a 5-year term, you're going to see through this problem, or 7-year term. But if you're a 2 to 3 year term right now, you bear a risk that you're going to have to come up for refinancing when there is a, artificial kind of revaluation of your assets. And what's great about real estate is it really is a long-term value that if you can last through a problem and not get squeezed out, generally speaking, you're going to be fine, right? Particularly in multifamily, where the cash flows are much more durable. You may see a dip in occupancy of a few points. Some of your new leases might transact at a lower rent, but you got a lot of existing cash flow. You can always squeeze back on some of your expenses for 6 months. You can ride through a problem as long as your debt isn't coming due, right?
Correct.
That's the main thing, is don't be squeezed out in a downturn. Okay, so your debt strategy in multifamily is critical. to your survival and value creation.
Absolutely. That's really, really very good advice. So coming back to the what you call the level of players in the market, right? So if you look at it in the past, before coming that, what do you think about the IO loan? Because I think in 2015, the lenders have loosened up, giving up more IOs to a lot more people. It has become default to have like 3-year IO, 4-year IO. Whereas when I started that time, I know it was hard to get even 1-year IO, and 1-year IO was so attractive because valuable. But then 2015 is when lenders start opening up the floodgate, and now it's like 5, 6 years, 7-year IO kind of thing. What do you think about that? How would that impact the whole market?
Yeah, I mean, look, from a cash flow perspective, if you have an IO, right, and so an interest-only payment, and you can get that for 5 or 6 years, okay, and but it's still fixed. It's like, so on the conversion, it's a fixed rate kind of conversion, right? Then great, you just got a great deal. Mm-hmm. The question is, you want your IO to be at a fixed rate. You don't want it to be floating. Mm-hmm. So if you can get a fixed rate IO, right, for a certain number of years, and you're guaranteed to convert to an amortizing loan at the end of the IO period at a fixed interest rate, well, you kind of got your cake and ate it too, right? Because you got the benefit of not paying down the principal during the IO period, but you didn't expose yourself to the risk of having to go through a renegotiation, right? Right. So great, if you can get it, go for it, right? I mean, that's fantastic. And you either can put that in your pocket or put that into the property, right? So that you're going to be able to expand your cash flow. It really depends upon who your investors are and what their goals are, whether it's cash now or value appreciation, later.
Yeah, I mean, correct. Where I was going with that question was, a lot of people have justified doing deals because the numbers with IO looks much better now, and once the IO expires, right? Looks really good, right? So a lot of investors are coming in, especially at the level where we are right now, where there's a lot of syndicated commercial real estate deals are happening. Right? There's a lot of people who just, they are very less sophisticated people who just look at a spreadsheet on cash and cash. You get 8% cash, right. They just jump on, invest in it, but that 8% could be IO, and in the next 3 years, let's say your rent doesn't go up or you have a dip in occupancy, right. Is what you're talking about, that 8%. And once the IO kicks in, that 8% becomes 3%, right? Right now, and if this occupancy going to drop, it becomes negative. So you basically can't service the loan. So I think, I don't know, in my perspective, there's a lot of deals happening right now in the past since 2015 with IO, especially at the less sophisticated level right now, which can cost.
Well, I mean, Jim, I would say IO should be gravy. It should never be the main dish.
Okay.
Okay.
Okay, but the problem is a lot of people are showing the gravy.
Yeah. If you're expecting the IO to make the deal work, okay, you're betting that by the time the amortization kicks in, the rents will have grown large, high enough to cover the amortization. Mm-hmm. Now, I haven't run the numbers on that, but that would be the thinking you have to get comfortable around is, okay, what has to happen, right? What has to happen when amortization starts such that it actually was a good deal? And then say, well, the rents have to grow at 1% a year, 2% a year, 3% a year, 4% a year. So you really need to stress test that assumption. But, this is where people, take risk. So if you're taking this kind of risk, understand that in a downturn, that's going to be the first people who basically get shook at, right? Mm-hmm. They can't make their principal. They paid too much. And when they had to start amortizing, they couldn't make a go of it. So I view that just as similar part as the equivalent of a debt maturity, right? Mm-hmm. It's like, okay, if you've got an IO period of 2 years and you bought the deal on the assumption that, you had to get your hurdle, the IO period is what made the hurdle work for you, you basically are sitting at a 2-year refi.
Yeah.
And you better,
Yeah.
you better understand that what your debt service requirements are when you're walking into that. I know we're spending a lot of time on debt strategy here, and I think that's kind of okay because the fundamentals are good, generally speaking, right? There's not a lot of too much supply. So demand's decent, supply is decent, and your debt strategy, right? So there's one part of this, which is your value creation strategy. What are you doing to create value for your residents, to make your property more attractive to them and a better living experience so that you'll be at high rents and high occupancies? And that's entirely valid. And I think, my view would be in terms of enhancing the resident experience, I think there's a bunch of IoT upgrade packages to existing properties that I think add a lot of security issues that people will pay for. Not so much through managing your thermostat, but if you kind of know that your kid can come in, right, and you can see on your phone when your kid came in from school and that they're safe, there's value creation there. So I think we as owners have to look critically at how are we adding value to the living experience, not just the four walls, but stickiness, right? Creating a stickiness that keeps people kind of in place. And so I think there's a whole set of strategies there. The debt strategy is to make sure that you don't get kind of shaken out. That's really my goal as a debt strategy, is not to get shaken out in a downturn. And if you can protect yourself from being shaken out in a downturn, then the fundamentals will basically bail you out. And so as we're talking about IO, which is people reaching to make the deal work, when, in some cases, I'd rather you focus on what can you do to add value to increase the revenues so you didn't have to go that crazy out financially.
Correct.
Right? So focus on the value creation part that provides the increased rents where you don't have to go 5 years IO and kind of crazy kind of amortization, and you're sort of sitting on a time bomb. So that would be kind of my take is, again, we're talking about debt, but it's more in the nature of put yourself in a situation where you can ride out a storm.
Yeah. That's awesome. Yeah, that's absolutely the right thing. Just make sure that you're on a fixed rate loan. And the other thing, which is very subtle, is even though you're on a fixed rate loan, make sure if you have IO and make sure you have enough buffer when the principal kicks in. Because from my calculation at 80% leverage, you need at least 5% cash on cash buffer. And on 75, it's like, 4%. You need
right
in terms of return to make sure you're still able to service that debt. Let's move on to a bit more a different topic, right? So selecting market, right? So let's say someone who want to start in multifamily, right? Multifamily, real estate is very local. At the same time, multifamily is a very, very it's an asset class where it's very, very intensive in terms of property management, right? So how would you recommend, how do they select the market?
Well, look, I look at a number of I'll call it very basic kind of fundamentals. Okay. And we have, and it's on our website and in our materials, we really have a 4-box model, about attractiveness of a city. And first of all, we come from the perspective of how is wealth created in this economy? And I would tell you that I believe wealth is created in this economy based upon the force of ideas and the creation of new products and services, which tend to have an intellectual capital component. Okay. So where and in which cities are new ideas being formulated into new products and services? Okay. We call that an intellectual capital node strategy, right? So we want to be in cities, and within that, in or adjacent to the parts of major metropolitan areas where there's a concentration of people who are doing work with their heads, okay, primarily.
Yeah.
Okay. All right. And then within that context, we use a 4-box model. Well, One is, first of all, how business friendly is the state within the United States? At the state level and at the city level, how friendly is the environment to the formation and creation and continuance of business? Next, we look at how many people are being educated in the area. So it's universities, community colleges, maybe even trade schools, but we're looking for where is intellectual capital being created, right? So basically higher education. And also I focus on the quality of the K through 12 school system, as well as alternatives for quality education for the poor, like charter schools. Okay. A third component is amenities. Okay, what kind of amenities and culture is being fostered that will attract and retain folks who are highly creative and intellectually? Okay, so you're looking for arts and recreation and culture and music and trails and things that sort of like people who are active, healthy, and thinking with their mind. Where is that in your community or any community? The fourth box is really the quality of the public-private partnerships that are going on. They're attempting to foster, this environment that makes it conducive for the creation of intellectual work, okay, and the attraction and retention of talent, which then powers the growth in a market. What we have found, and we've done this for the top 40 cities, metropolitan areas of the United States, is that these places happen inside metropolitan areas, and they don't happen everywhere. It's not uniform. It's kind of, there's clusters of them, okay, in any particular metropolitan area, and we've gone actually through the work of mapping those, okay? Now, all of that is you kind of sort your way through that, okay? And we do this all across the United States. And I track also very clearly domestic migration. You've seen tremendous amount of domestic migration out of high-cost cities and into cities and states that score well on these kinds of all these four attributes. Okay, so in Texas, Austin, Dallas, Houston, and to a lesser extent San Antonio all score well in these areas. Okay, and that is where, if you look at where people are moving from and where they're moving to, and where are businesses moving from and moving to, that's why, I'll go giving a view of the entire country, right? Mm-hmm. That's why Orlando, Tampa, Las Vegas, Phoenix, Atlanta, Raleigh, Salt Lake City are all doing incredibly well, because they have a combination, right, of good governance, good weather, which helps, okay? Yep. Plus these other conditions where, where businesses are moving and where talent is moving. Now, it's not to say that if you're in a core, we call it a global gateway city, those cities aren't going away anytime soon. They are, major centers of intellectual capital, but they're in places and in circumstances where you're kind of swimming upstream as a real estate investor, okay? And there is an increasing level of political risk associated with that as well. So among the core cities, the top six, and usually you can think of these cities as, generally speaking, and am I on the right track, Jim, of what you wanted to hear?
Yeah, absolutely. Go ahead. That's very, very helpful.
I can keep going on this, but
I want you to.
The core cities are viewed as Boston, New York, Washington, mm-hmm. Chicago, LA, San Francisco. Mm-hmm. And sometimes I'll call it Miami, because it operates like a core city, okay? And if you look at among those core cities, all right, Boston and Miami are kind of like the best positioned. Mm-hmm. And the other ones less so, because of the very high costs and the tax bill in the tax law isn't helping, right? So those areas were bleeding people anyway, mm-hmm. and now they're bleeding more.
Okay.
Yeah. right? So Boston is pretty well positioned. Miami is pretty well positioned. But even within Miami, there's significant out-migration from Miami to Orlando and Tampa. Okay, so I like Orlando and Tampa in that regard. And there are certain markets that I think are great markets, okay, but there's a lot of supply currently. Dallas is an example in Texas. Houston is a highly diversified economy, but there's also a large supply response. So in Houston, I would say you have to be very localized. So you want to be in places where there's some traffic congestion, and you're very close to places where either the Anderson Medical Center or the Energy Corridor, where people want to be, and there's a certain level of stable demand. So that's kind of the story on Houston. But there's also other cities: Seattle, Denver, Charlotte. These are great cities. They do have a lot of supply that they're currently working through. If I was talking to someone in the Midwest, I'd say Minneapolis is a really good city because of its. The weather goes against it, but it's a kind of a core great market, particularly in the suburbs. Indianapolis and Columbus, their downtowns are sort of emerging and creating something because of their good intellectual capital and very low cost position. So they are kind of like the king of that hill, as it were, right? And they're getting benefits of outflow from Chicago, but most of the Chicago outflow is going to Florida or the Carolinas, not so much inside the Midwest. So this is the way I think about cities. Of you want to be in places, and so if you're a smaller investor that says, look, I'm only going to invest wherever I am. I'm going to only invest to the extent that I can drive to it. I'm 2 hours, So okay, fine, that's great. Go and look for the locations within your 2 hour driving radius. All right, go look for those locations that have these conditions. Where is intellectual work happening? And some of the best strategies are to be in an area, find that area, and then find an area that's low cost to rent adjacent to it. So you have even though you have a cost advantage, that's within 10 minutes of drive time of an intellectual capital node. And intellectual capital nodes are found, honestly, in most of the top 40 U.S. cities. You can find them. They're there. We do this for our clients, but anyone can do it if they do have the time to spend. And again, if you're investing within a 2 hour radius of where you are physically located, then your job is to get to know your economy, your regional economy, and understand where interesting work is getting done. And that's where you would tend to spend your time. That's how I think about it. So when I come back with certain cities that are attractive or certain cities that are unattractive, it's first looking at the basis, right, in this intellectual capital work, and then layering in, supply conditions on top of that.
So are you saying that an investor in Texas, should not go to some other city and look for deals? I mean,
well, I'd say is understand that when you, as a sort of non-institutional investor, go out of your immediate, ability to touch the real estate. If you have to get on a plane, okay, and you're a non-institutional investor, you are eroding your returns. So what is your competitive advantage as a non-institutional investor? So you have to be very sort of upfront with yourself. And I would say your competitive edge as a non-institutional investor, right, is not going to be necessarily a cost of capital, right, because they're going to lower cost of capital. It's going to be that you can have more intimate knowledge, and you can get to the real estate more closely, and you can provide more attention to it than anyone else can. That's your advantage, okay? Or investing in assets that a large institution would not attempt to invest in. Maybe a 50-unit property, because they won't want to touch that, right? Because it's a little subscale. You can't have a major property management company manage it. It just doesn't work in their strike zone. So you got to look for assets that you're not going to have competition from institutional investors, and where you can bring a competitive advantage. And if you have to get on a plane to see it, and you have to have a third-party property manager who you eventually can get to it, where's your competitive advantage?
Yeah, I think. Yeah, you're absolutely right. I mean, a lot of people thinks that where they are, they can't find deals, and they start going somewhere else, and they have become out of state investor, right? So at the end of the day,
and they're becoming out of state investor. I would say, if you're at the point of having, a big office and a large staff and a big discretionary fund, then you have the infrastructure to go across geographies across the United States. If you are someone who doesn't have those advantages, well, play to your strengths, which is go to places that those investors can't go or won't go, and focus on your intense knowledge, right, of the local economies that you can get to within a 2-hour drive time. And you get, depending upon the cities and the region you live in, 2 hours is not, slim pickings. You
can go far.
Focus on where you can add value. I think all of us have to focus on where we are going to add unique value, and that's what we should spend our time on. Definitely how we as an organization decide how we're going to spend our time. And if I can't find a way to add competitive value, to create value, I'm just not going to go do that activity because someone else can do it better. I need to focus on what I can do uniquely better that no one else can do or very few people can do. And that is getting, if you're a multifamily investor, it's being in asset classes that are smaller than institutional investors and knowing, where the nodes are and being in an adjacent place to those nodes with a class B or C asset and focusing on value creation to the resident that makes your property, more desirable, more valuable, because you don't want to be just a box, right? That then you're in a commodity market. You want to create differentiation, either in the living experience or the things that you offer, and ideally, like IoT upgrades or other sort of upgrades, where people will pay you, right, for these additional services because they add so much value to their lives, and that's where you want to focus on.
Awesome advice. So let me ask you one more question before I let you go. So between the primary, secondary, and tertiary market, right? So I think we have to define primary very specifically. Primary means is all the coastal city, like gateway cities, right? So
well, and the way I define primary, I really view it as, it's not primary, it's not a good term. We kind of view it as international gateway cities. So there's 7 U.S. international gateway cities. There's primary markets, which are really the top 30 metropolitan areas, okay? And primary, in my mind, would include places like Dallas and Houston, okay? And Austin. They're big markets. Then we have, I would call, secondary markets where the economies are not nearly as diversified, okay? And then you're getting into smaller and smaller metropolitan areas.
Okay.
That makes sense?
Yeah, it makes sense. So people go nowadays to look for yield on the tertiary market, right? And secondary and tertiary market. So do you think that's a good strategy?
Here I'd say maybe, okay? If you're going, and I've seen people who go to Huntsville, Alabama, right? And they've gone to very, very small markets, okay? In a search for yield because their investors are looking for current returns. First is the metropolitan area you're investing in going through a process where it's changing its fundamental character, okay? So there is a significant, if you were able to identify that Denver 15 years ago was going to go from a tertiary market to a solid kind of viewed as a major metropolitan investment grade market, you made a lot of money because in that transition of the city, okay, it was able to attract now a new group of investors who had a higher willingness to pay. So one strategy, if you're going to a smaller city, is the city in the process of changing its fundamental nature. Okay, that's a key issue. Because if it is, then you're basically riding on a trail. And I would say there are some cities like, believe it or not, Orlando and Tampa and Phoenix that are changing the fundamental nature of their city to be less volatile and have a broader and more stable kind of basis to their employment. If you're going to a really tiny market, all right, and I've seen an investor go to Huntsville, Alabama, and buy an asset next to a NASA facility. Well, that made a lot of sense, right? You have basically found a very interesting special situation in a very small market with good intellectual capital characteristics. But the city, let's say Huntsville, again, I don't know if I may be doing dishonor to Huntsville. If I am, I certainly apologize. I'm not familiar with what's going on in Huntsville. But if that city is not fundamentally changing its character, then your issue is that there's not a lot of other people for you to sell to when it comes time to sell, right? It's the asset is what it is, and you are basing your return on what overall capital market conditions are when you decide to sell. Now, if you never decide to sell, it may be a great cash flow play, okay? I'm not saying it wouldn't be. But you need to be kind of honest with yourself. If you're going to a smaller market than you've been in the past, are you going there because you think that city is changing its fundamental character and will change to have the characteristics of a bigger city and will grow to that bigger city? In which case, I would say it's a very viable strategy, very worthwhile strategy. If you're going only because you're getting a higher cap rate, and that's it, then you are taking on a lot of risk. And you ought to be honest with yourself and not kid yourself.
Yeah. And also I've seen in the past when the economy, when the recession hits, the tertiary market is the first one to get hit as well, right? Is that right? Because
again, with the exception of this asset that's near NASA, those economies are not broadly diversified. They're generally the basis of that local economy is usually one or two industries, and there's a greater likelihood that one or two industries will get hit, and you will have exposure that you can't get around, and there's nobody else for you to rent to. So that is very clear. So you do want to understand what's the basis of the local economy, and do you understand what that basis is, and are you willing to accept the exposure that comes with your renter pool being dependent on one or two industries?
Got it.
Now, you might pick right and say these one or two industries will not be affected by changes in the broader economy. Okay, but I will say, generally speaking, that these other industries in a smaller city will tend to be more focused on manufacturing and extraction, mining, and some kind of extractive industries, which are affected generally because the real estate cost is lower, right? So there's less intellectual capital work being done. It's more extraction or transformation of things, and those do tend to get hit pretty hard in a downturn. So I just think you're taking on more risk.
Got it. I don't want to take up too much of your time. I got so many other questions, but I have to respect your times. And
we'll have to set up another time, and maybe we can do round two. Okay,
round two. Yeah,
it's been a pleasure being on your podcast.
Yeah. Do you want to let people know on how to reach you or how to get subscribed to Yardi?
Yeah. Well, the easiest way to do is go to www.yardimatrix.com. It's one word. And on that website, you'll see the publications department. You can sign up for stuff. You'll see my contact information if you want to reach out to me personally or any of my team. And that's really the best way to kind of get in touch with what we do. And hopefully, this has made some sense to you. And I wish you all much success in your investing.
Thank you, Jeff, for being with us. Thank you.
All right. Take care now. Bye-bye.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.